Hello, everyone. On one hand, we are navigating through an unpredictable global growth and trade environment. On the other, India's domestic macroeconomic dynamics are firmly supportive of economic expansion. In this session, we will explore some of the macroeconomic indicators that would offer valuable insights for investment allocation into fixed income space. I am Sandeep Solanki, product specialist, and I'll be joined by Mr. Anurag Mittal, our head of fixed income. Following Anurag's presentation, we'll open the floor for Q&A session. Please feel free to submit your questions using the Q&A link provided throughout the webinar. With that, let's get started. Over to you, Anurag.
Logging into the webinar. We really hope you find this webinar useful. We'll be discussing the major global trends who are shaping up, the fixed income narrative globally and how it affects India, and what are the key major drivers for Indian rates as well, and what kind of products are making sense in this kind of rate environment. So we'll start with the global trends first. So one of the aspects since the new administration has come in the US is its stance on tariff, on the way tariffs were levied across a way. So as on Liberation Day, US levied a 155% tariffs on China, which effectively put an embargo on Chinese goods imports in the US, and a very similar high rate was levied by China to the US as well. So what there was an update there in the month of May, in which the US and China bilaterally announced that they will reduce tariffs on some of the goods, which would in effect reduce the trade weighted tariff to 40% from 155%, and they will enter into a 3-month negotiation stage in which they will try to resolve many of their pending issues, and they will come to a mutually agreeable tariffs at the end of 90 days. While this is a very, very tight timeline, and we are not sure whether they will be able to come to a agreeable conclusion within 90 days. However, at least for the next 3 months, it gives some relief, to the manufacturers, and broadly, it also pushes back, the growth slowdown expectations, because one of the factors behind, the strong growth slowdown beliefs were that at some point of time the US-China trade will collapse. There will be a major slowdown in global trade volumes. There will be a huge deflationary export from China to rest of the world because of restrictions in the US. And since that's been postponed by 3 months, even the rate cut expectations from the Federal Reserve and even the deflation expectations from China have been pushed back at least for the next 3 months. One of the other interesting aspects was the US Court for International Trade. They flagged off that the order under which the tariffs were levied on China and rest of the world were coming under Emergency Economic Powers Act, in which the president is authorized to levy tariffs on various nations without going through the House or the Senate. So the court found the tariffs to be illegal, and they said that they probably don't really constitute an emergency under which the president had to bypass both the House and the Senate. The administration has got a temporary stay order from the federal court. So far, they have got in a way that the 40% tariff stays for now to China, and so but if these emergency tariffs were to be revoked later on, the effective tariff rate comes down to a much more manageable 5 to 6% from a 13.5% effectively. So overall, it remains to be seen, how the legal course takes place. But I think more importantly, what's really, what market participants are considering is that tariffs will continue to be a core lever of trade policy for the US. And ultimately, it's the bilateral tariff negotiations which the US is conducting, whether it's with India, China, Japan, or Korea, And so every country will have to do bilateral tariff negotiations, which will be time consuming, which will create a lot of uncertainty on new, uh, I would say, either it's export orders or it's new capex decisions by the private sector. But broadly, at least in the near term, it removes the overhang of a total collapse in global trade. So global trade can continue. At least all these negotiations are happening at the background, and hence the near term growth outlook remains quite stable. If you look at corporate margins, especially in the US, they are quite high. If you look at the leverage, most of the private sector had used the pandemic to deleverage their balance sheets in the US as well, just as they did in India. And overall balance sheet remains quite healthy. So we don't really expect any major impact of these negotiations on the near term growth outlook. As far as the EM policy implications are concerned, so while Fed may still want to wait out for the effect of tariffs on inflation and growth and then probably take a call, but for EM central banks, given that the new capex announcements or the new investment announcements will become uncertain, and on the margin it is growth negative, we still believe that the EM central banks will continue to cut their policy rates to focus on growth, as inflation appears to be quite stable, at least for the next 6 to 12 months. A case in point being India, as they cut their policy rate by 50 basis points in June. Similar actions will be taken by other EM central banks going ahead as well. One of the other notable aspects of previous month was US lost its last AAA rating, while when Moody's also downgraded US sovereign rating from AAA negative outlook to AA1 stable, which is broadly in line with the AA plus ratings of S&P and Fitch as well. Um, so mind you, and we will discuss it later on, when S&P and Fitch had downgraded the US ratings on, again, on worsening fiscal policy, on too much of gridlock, on improving the sustainability of US debt dynamics, the market had not really reacted materially. But if you look at this particular rating downgrade, this was taken quite seriously by the market. If you see the amber chart, which is on the left hand side, which denotes the US 30-year, it crossed 5%. And even if you look at the US 10-year, it moved from about 4.1 to 4.5% and now stabilizing at 4.4 at the month end. But broadly, the downgrade was taken quite seriously by the market, because it doesn't just reflect a temporary debt worsening situation. But if you look at an overall macro imbalance in the US, and if you look at the chart on the right hand side, which signifies the US budget deficit as a percentage of GDP, as we can see, since 2018-19 onwards, the US fiscal balance has been worsening. Of course, during COVID, it really went all the way till 15%, but it hasn't really consolidated back to its pre-COVID trend of around 3%. It's still at around 7% as of calendar year 2024. Even if you look at going forward, it remains to be in up of 6%. So overall, the rating agency has called out that it's the debt dynamics of the US in question. Secondly, even the budgetary bill, which is proposed to be passed, by the House and the Senate, which the president has called a big beautiful bill, even that's pushing the fiscal deficit close to 7%, because it will also be extending some tax cuts which the president had proposed in his first term in 2017. So there will be income tax as well as corporate tax cuts in the bill, which will again make some of them permanent, and broadly it will become very difficult for US fiscal deficit to come back to its pre-pandemic trend rate. So if we move to the next slide, as you can see on the left hand chart, and there's a line during 2011-12 which shows the rating downgrade by S&P. And if you look at, after 2003-24, there's again a line chart which shows the rating downgrade by Fitch. And if you look at, the first rating downgrade, interestingly, US 10-year actually rallied after the first downgrade by S&P. And if you look at the dollar index, that actually rose after the downgrade. The reason was that downgrade was coming in a back of huge global uncertainty, especially in Europe, at the time when Europe was grappling with the Greek and the Portuguese debt crisis. So there was a overall assessment that probably it will be very difficult uh, overall for the world to really uh, come out of the debt crisis. So not only the US but other economies will also face sovereign challenges. And despite a US rating downgrade, the financial market treated like any other event. And in fact, they saw that rating downgrade that if the US is not safe, probably the other countries are also in trouble. And they so in fact the dollar rose up in the safe haven demand. But if you look at the current downgrade by Moody's, it's totally changed the equation. Why? Because if you look at the chart on the right hand side, which signifies US net international investment position. So net international investment position is basically the balance between the assets held by Americans abroad compared to the assets which are held by foreigners in the US. So all the assets put together, whether it's equity, real estate, fixed income, central banks, or any other entity which is put together. So if we can see since 2006, they have been consistently on a declining path as a percentage of GDP. So all that was fine so far. But what US is trying to do under the new administration, it is trying to reduce its current account deficit. So what really US is was doing right now, it was running a current account deficit for the rest of the world. And with the rest of the world, so broadly, the rest of the world was earning in dollars, and the rest of the world was deploying that dollars back into the US. So as now US tries to reduce the current account deficit with the rest of the world, what that means is the rest of the world will earn less dollars, and hence it will have less dollars to invest in the US incrementally. We still don't think that there is a major shift in investment strategy as things stand today, but going forward, as the US has kind of indicated to the world that we want to reduce trade with you, and as global trade reduces, that broadly means that on a net basis, dollar earnings for rest of the world economies will reduce, and hence their incremental investment in the US will also reduce. And at the same time, US fiscal deficit is increasing, and that means more duration supply, more dollar debt supply. So at the same time, when your dollar debt supply is increasing, you are shrinking the base for your natural buyers. So that leads to a certain demand supply balance, and that is why at this rating downgrade, this time market really paid some attention to the downgrade, and hence we saw both dollar index declining as well as US treasuries declining as well. So we'll have to really watch out for how the US fiscal negotiations take place, on how whether US is really able to successfully demonstrate a meaningful fiscal consolidation model. And probably at that point of time, we should see some pullback in US Treasury yields as well as dollar index compared to other currencies as well. The other part which we wanted to highlight is if you look at the left hand side chart, which is the Shanghai to Los Angeles container freight, which is one of the most tracked indicators. So as we can see, before the Liberation Day, what we saw was total collapse in freight rates, because as market participants were expecting US to levy tariffs on rest of the world, including China, there was a sudden drop in economic activity between US to China. And as the US and China are starting their renegotiation on tariffs, from 155 to 40, we are again seeing pickup in economic activity, which you can see the freight rates bottomed out in April, and they've again started to show up in the month of May. If you look at the commodity index, overall commodity index saw a decline in May because as energy prices declined, as well as gold and silver prices saw some profit booking from the record highs. But as economic activity again starts to normalize, we do expect commodity prices to again stabilize. We do expect energy prices also to stabilize. So probably this commodity index will become more stable going forward. If you look at global bond yields, we talked about U.S. bond yields after the downgrade, but not only the U.S. but other bond yields also rose in the month of May, ranging from 5-10 basis points. For example, Germany just rose by 6 basis points to U.S., UK, or South Korea, which rose by about 20 basis points. The reason was again, like I said, the market repriced the repricing of cuts, which was broadly when the Liberation Day tariffs were announced. Many market participants saw that probably if those tariffs were to continue, there will be a collapse in economic activity and there could be a major slowdown, and hence Fed would have to cut rates much more aggressively. So market participants who were just expecting 50 basis rate cuts from the Fed in the current calendar year started to reprice about 100 basis of rate cuts. But as US started to freeze on some of the tariffs hikes, and they went into negotiations with many economies, whether it's India, China, Australia, UK, etc. In fact, they successfully concluded their free trade agreement with the UK. That template gave, rise to hopes that probably US will not be levying very draconian tariffs on rest of the world, and there will probably be one-to-one deals, and hence the slowdown in growth, which was envisaged in April, probably there was some correction on that, and that also led to repricing of cut expectations from the Federal Reserve again from 100 back to 25 to 50 basis this year. Also, during the Fed meeting, many Fed officials also said that they will want the full effect of tariffs to play out and final negotiations on tariffs to happen to really take any rate actions. So both from the Federal Reserve as well as from actual action from the administration shows that the near-term impact of tariffs will probably be limited on the growth front. Of course, it's marginally negative for inflation, but from a growth front, it's not as meaningful as many participants were fearing in the month of April, and hence we are seeing much more muted reaction on bond yields. So as you can see on the financial conditions index, so the U.S. financial conditions tightened at the margin. While U.S. equities remained quite stable, it was largely the U.S. Bonds and especially the U.S. Treasuries which saw significant rise in yields in the month of May, as we discussed in the previous presentation, due to the one rating downgrade, as well as that probably the Fed will go slow as tariff negotiations happen. If you look at the market implied policy rate forecast, so earlier market participants, if you look at the month of April, market participants were expecting the rates to settle somewhere between 3.5, which now again have come back to 4%. So the 50 basis repricing has already happened on possible Fed rate cuts. So coming to Indian trends, so the most important event which happened recently was the RBI MPC policy on 6th of June, where the RBI voted 5:1 to change the policy rate by 50 basis points to 5.5 against consensus expectations of 25 basis points. Not only did RBI cut the policy rates by 50 basis points against the consensus, they also changed the stance to neutral from accommodative in just one policy. To recap, RBI had been in a withdrawal of accommodation mode since 2022, and they had been maintaining the policy stance of withdrawal of accommodation, till they moved to accommodative policy stance in till April. And in just one policy, RBI has changed the stance back to neutral, which is quite unprecedented, because usually when central banks go for a policy stance, at least we have not seen central bank changing the policy stance in just one policy. Just to give a perspective, the RBI had defined the accommodative stance that either they will hold the policy rate stable or they will go for a rate cut. What a stance, in terms of neutral means for RBI is that they can go for a rate cut, they can hold the rates, they can even hike the rates. Uh, so while the stance change may seem to be quite strong, uh, we believe the reason for stance change was having cut policy rates by 50 basis points and keeping them, bringing them all the way to 5.5, and especially when the market was expecting only 25 basis points. If the RBI had not changed the stance to neutral, and if they had continued with the 50 basis cut, market would have expected more rate action in the August policy as well, and it could have led to meaningful volatility in market reaction if RBI would have not continued the rate cut cycle in August policy as well. Since RBI was quite clear, as confirmed by governor in the press conference as well, that most of the policy easing has already happened and they are not seeing any major rate cuts from here on. The RBI wanted to also kind of give this messaging to the market by changing the stance to neutral, that the most of the policy action has been front loaded. Since typically central bank actions take 2-3 quarters to take really have an impact on the real economy, what RBI wanted to do by this policy was to, instead of doing two rate cuts in June and August of 25 basis points and having their effect play out much ahead, after August, they wanted to see the whole benefit to the economy probably much faster. And not only they changed the stance to neutral, they also cut CRR by 100 basis points to 3%. Mind you, the last time the CRR was taken to 3% was during the pandemic. So, so this is a very, very strong signal given by the central bank to the banking system that the liquidity will be kept uh, positive to ensure faster transmission of the existing rate cuts. And this CRR cut has come at a time when the system liquidity, which the interbank liquidity and government cash balance, if you take that into account, is already at 6 lakh crores. So to do a CRR cut, which will release about 2.5 lakh crores into the banking system, when the system is already sitting at a 6 lakh crores liquidity, gives a very strong messaging to the banks that there will be abundant liquidity at all points of time so that they can plan their deposit raising activity accordingly. They don't need to aggressively raise deposit rates. So when they're not raising their deposit rates, when they're not chasing deposits, they can in fact reduce their lending cost, which should probably kickstart consumption and some investments down the line. If you look at the CPI inflation assessment, as we can see, from 4%, they have now moved to 3.7% in the current policy. Most of the reduction has come in the first quarter for FY26 and the second quarter from 3.6% in April 25. Now the inflation estimate for first quarter of FY26 has been reduced to 2.9. If you look at the second quarter, the 3.9 has been reduced to 3.4, and the last two quarters has been broadly kept unchanged. If you look at overall growth assessment, the growth assessment has been kept unchanged at 6.5%. So it's the reduction in inflation from 4% to 3.7%, which gave RBI greater confidence to cut by 50 basis points and at the same time also give liquidity. Interestingly, RBI has affected the CRR cut from September onwards. So the CRR cut is not really affected from today, but by September. One of the possible reasons for doing CRR cut in September is that RBI has about $15 billion of negative net FX forwards, which are maturing in next 3 months. So as RBI gives the delivery of dollars to the system, it may lead to about outflow of about 2 lakh crores on static basis. So that gets kind of set off with the CRR cuts which RBI has given. The second part which RBI also brought in the current policy, that so far RBI has been working on potential growth. So potential growth is a growth rate of an economy in which the economy is neither hot or cold. That means neither the inflation is going above central bank's target band, neither inflation can go below central bank's target band. So what RBI has brought in this time is the aspirational growth. So the potential growth as estimated by many economists for India in recent times has been around 6.5%, which is already RBI's projection, which we already achieved in FY25. So by bringing in an aspect of aspirational growth of 7%, what that means is that growth is at the forefront of RBI's monetary policy, at least till the time inflation is close to 4.5%. So we think RBI will continue to provide liquidity. RBI will continue to ease regulatory burden on the banking system to ensure that there is sufficient credit growth to take the real GDP growth close to the aspirational level of 7% rather than just the potential level. So that's, I think, the key takeaways one should take from the RBI monetary policy. If you look at the monsoon trends bode quite well for food inflation outlook. So if you can see the monsoon, the IMD has forecast southwest monsoon to be 106% of long period average compared to 104%, which they have forecasted some time back. So there's an upgrade in the monsoon forecast. And if you look at the actual IMD track record, and especially since the last 3-4 years, there has been a meaningful improvement in the technology which is being used in India. And if you look at the forecast errors, earlier, if you see till 2020, the forecasts were off compared to the actual rainfall by 6-8%, even 16% in some cases. And if you look at the last three years, the forecasts are in very, very comfortable margin of 1.5%. So overall, we think the predictive ability of IMD has really improved in the last 4-5 years, and we should expect high rainfall and overall food prices to be quite benign. Also, what good monsoon means for rural economy is better income and high demand from rural sector as well, which overall is quite positive for growth. If you look at the MSP prices have been announced for Kharif 26, and they have been very, very muted and very stable. So if you look at, for example, for paddy, it's just 5%, for bajra, etc., cotton, etc., again all low single digits. So overall, the MSP prices have been kept very stable and very favorable for food inflation. Again, liquidity, like we said, continues to be quite favorable. As we can see, the system liquidity was about 2 lakh crores. If you take into account the government cash balance, the core liquidity is in excess of 6 lakh crores. As RBI paid out dividend to the government of about 2.7 lakh crores, that has resulted in government cash balance increasing from about 2.7 lakh crores, because the money which goes from RBI to the banking system broadly it adds to the monetary base of the economy, because that cash is in a way created by RBI in the economy. So, like I said, RBI has about $15 billion of net FX forwards. If you look at total, they have about more than $50 billion of FX forwards which are maturing within the next 12 months. Even if RBI were to give delivery of about $25 billion and let the other roll over, that still results in a liquidity leakage of about 3.5 lakh crores, which should be offset by the CRR cut. So overall, we do expect liquidity to remain quite comfortable for the next 12 months. If you look at the credit deposit gap, so at least if we look at from FY22 to 24 perspective, if we look at this chart as well, the green line remain much higher than the blue line, which signifies much faster credit growth compared to the deposit growth. But if you look at the gap between the green line and the blue line, it has started to shrink since last 6 months, and now it's become very narrow, and broadly, which reflects the non-food credit growth slowing down. In fact, it slipped below 10% to 9.6% as on 16th May. Usually, the first quarter is a lean season, so we do expect credit growth to pick up in second half. But overall, it does reflect that banks are not really experiencing very strong credit growth, and hence they will not be uh, in a need to raise aggressive deposits as well. So one, you have easy liquidity in the banking system, and on the other hand, banks are not really needing to raise deposits at aggressive levels, which overall plays out very well for short to medium end of the yield curve. If you look at the trade deficit as well, the trade deficit widened for the month of April as some of the exports were front loaded, ahead of the Liberation Day. Of course, we saw a huge fall, in oil exports. So that's something which we'll have to see, going forward, how oil exports pick up. If we look at, non-oil, non-gold imports, they continue to be quite muted on a month-on-month basis. So we'll have to see, how they continue to perform. The underlying factor which has been doing well for India is if you can look at the service exports. So service exports are now averaging about $18 billion, and they are offsetting about this this 25 billion odd trade balance. So if you take that into account, the net trade deficit after accounting for service exports is about 8-9 billion, which is easily offsetable with the 100 billion of remittances that India receives, in any typically in a financial year, and hence we do expect India's external account position to be quite robust. So broadly, if you look at the sovereign yield curve, that continued to steepen, which means that the segment of whether you can say 1 year, 3 year, 5 year, they continue to outperform the long end because of easy liquidity. So typically in any rate cycle, at the beginning of the rate cycle, it's the long end which performs well in the anticipation of rate cuts. And as we move into the period of rate cuts, it's the short to medium end, which is basically up to 5 year end of the yield curve, which does relatively better, because as the actual overnight rates go down, liquidity becomes easy. Market participants are happier to hold shorter end papers rather than longer end, because now the focus is that how long will these rates stay low at current levels, and when is the next inflection point for rates. So at that point of time, market participants prefer to hold shorter dated securities. So if we discuss the curve movement and overall, credit spread trends, we saw a rally across rating spectrum and across the maturity spectrum as well. So if you look at whether 1 year rates, 3 year, or 10 year rates, overall we saw a significant down move in yields in the month of May due to the rate cuts and due to the easy liquidity that has been there in the system. At some point of time, this should also translate to loan rates. But what does that mean for whether it's government bonds or corporate bonds? Is that you are seeing the benefit of a lot of the benefit of expected rate cuts have already been priced from the market. So it's quite important to see this movement from a future perspective, forward-looking perspective, that a lot of it's been priced in the bond curve. So you may not see a further down move in yields, which you saw in the month of May going ahead as well. So broadly on the outlook, since RBI now is in a neutral phase, what it really means is that we are in a lower for longer regime, because one, RBI is quite comfortable with inflation. It's expecting about 3.7% CPI for FY26. So does it mean that it will cut rates? Given that RBI said that there is very limited room to cut rates down the line, it means that RBI will probably keep rates at current levels. What it means is when they are cutting CRR and they are forecasting it well in advance, that means that they are likely to keep liquidity quite easy for the banking system to ensure transmission of their rate cuts to corporate bond market, government bond market, and to the loan and deposit market. So we are in a similar regime that we saw during demonetization, where rates were not aggressively cut, but liquidity was quite easy during 16 and 17, and that led the short to medium end of the yield curve coming down. It's a similar situation to the post-COVID world in the late 2020 calendar year and the 2021 calendar year as well, where market participants were not expecting further rate cuts, but they were expecting rates to be maintained for a long period of time, also in a period of very easy liquidity. So what happened during those periods, whether it's demonetization or whether it was the post-pandemic pre-normalization period, it's the typical your short end to the medium end of the yield curve which performed, because investors didn't have a very strong and a very long degree of confidence that probably rates will remain low for a very, very long period of time. So hence they were comfortable holding 1 year, 3 year, or 5 year papers, which remain quite stable, which were providing them very good carry. And because liquidity was easy and rates were at the lower end of the corridor, there was a strong investing behavior by whether it's banks, insurance, or any of the market participants to ensure that they're able to protect their accrual. So overall, that also compressed, the spread between the overnight rates and the 3 to 5 year bond space. So we do expect the same thing to play out going ahead as well. We do expect spreads between 3 to 5 year to overnight to further compress as liquidity remains quite ample. Uh, we have been talking about steepening for a while now, and as we can see, as we saw in the previous slides on the yield curve, uh, we are seeing steepening play out quite well in the last 6 months. We do expect steepening to play out for the next 3 to 6 months as well. So we do expect the short to medium end of the yield curve to do well, and hence we recommend investors to continue their allocation to strategies like corporate bond fund, short-term fund, etc., which typically run duration between 1 to 4 if they have an investment horizon of more than 12 months. If investors have an investment horizon of 6 to 12 months, they are better off allocating their fixed income allocation to low duration or money market strategies, which run duration between 6 to 12 months, which should also benefit from this period of easy liquidity. And I'll stop here for now, and I'll open the floor to questions. Thanks for listening in.
Thank you, Anurag, for the valuable insights you shared. Let's move on to the questions we have received. The first question is, with US credit default swap spread now trading at a premium to several countries in the likes of Spain, South Korea, Portugal, despite US holding the higher credit rating, market seems to be questioning the risk-free status of US treasuries. In your view, what could be the potential spillover effects of this development on the emerging markets like India, particularly in terms of capital flows, currency stability, and government bond yields?
So, markets in their phases of consolidation tend to move both ways. Uh, at some point of time, there will be an inflection. So either US will clean up its fiscal act and yields will stabilize, even the credit default spreads on US bonds will stabilize. Or if US continues the same path, probably at some point of time, the actual market behavior will continue to further manifest from credit default swaps to even US equities or US bonds or US dollar as well, compared to other currencies. So I think at some point of time, its market is testing till what time does the current administration continues to add uncertainty to this fiscal equation. So it's not just about the current trajectory of US fiscal deficit or US current account deficits. It's about reliability of US bonds or US financial markets as an anchor to global financial system. So it's the uncertainty also which is bringing out this reaction. So probably once we have more clarity on the likely trajectory of US, tariff policy, probably some of this volatility should reduce. As far as the effect of this on emerging market flows, Uh, you know, so there are two parts to it. One, we think that net with all the policies that the US is taking right now, the global growth momentum should slow down, because whenever there is a large amount of uncertainty, it leads to hold off of any investments by the private sector, because they do want clarity in investment climate before they commit further capital. So till there is strong, clarity, of course, it's slightly, I would say, growth negative. I will not say it's majorly growth negative, but on the margin it is, and hence, uh, typical EM capital, which is growth chasing, right? It does tend to slow down in current or in such kind of environment. Uh, as far as India is concerned, if you look at the fundamental drivers of India, since India, you know, largely relies on domestic private consumption, which is more than about 55% of its GDP. We don't think Indian growth outlook is materially, I would say, deteriorating because of these tariff issues, or whether volatility in US treasuries. So overall, our growth outlook remains quite stable. So relatively, we may still do better than other emerging economies. But yes, on an absolute, these kind of uncertainties always creates volatility in flows, always create volatility in financial markets. At some point of time, we do expect stability to take place, but in the near term, we do expect flows to remain volatile.
Okay, thank you, Anurag. So the next question is, the proposed US legislation to tax overseas remittance could significantly alter the global remittance dynamics. While India may not be as dependent on remittances as the share of GDP, the absolute values of inflows is substantial. From your perspective, what could be the implication of such tax on India's current account balance and financial system liquidity?
So US right now has proposed two taxes. One is on the remittances. One is also on the capital gains. So any investor who has invested in US bonds, equities, or real estate can also be levied to higher taxes. These measures are yet to be passed by the Senate, so we don't know whether these will get passed or not. But let's say these were to be passed. So I'll take the two different sides here. So one is the remittances. So we get about 20% of our remittances from the US. If it's taxed at, let's say, 5 to 10%, uh, so of course there's a full pass through of that tax, and so we receive about $2-3 billion less remittance, compared to previously. So the effect is there, but it's not material. So it's just 2-3% of our total remittance inflow. So we get about 105 billion dollar of remittance inflows. But on the margin, yes, it's a negative sentiment dampener, but I don't think it changes our current account dynamics materially. On the other hand, if the US tax on foreign assets were to take place, that can meaningfully change asset allocation behavior, because that will drive away capital from the US dollar to other developed market currencies. It could be yen, it could be euro, could be pound, some of it may go to even RMB. But broadly, that can have a major implication on how assets are priced, assets are perceived, because many of the other markets that I talked about, they are offering very, very low yields. For example, Japanese 10-year is just about 1/4, 1/2%. German 10-year is about 2/2. So these, and compared to US 10-year, which is at 4/2. So we'll have to see how that investment behavior happens. And probably at some point of time, we may see some flows to emerging markets like India also, because they will offer much better yields than some of these other economies. So I think we have to take things holistically. So probably standalone, it may sound negative, but we'll have to see really how overall, uh, regulations take place both on remittances as on and on investments, and their effect on overall flows.
Thank you. So the next question is, now, as you mentioned, with a significant portion of RBI's forward book set to mature in coming months, what could be the possible impact on the durable liquidity from an Indian economy standpoint?
So, like I mentioned, RBI has about 70 odd billion-dollar negative forward book, out of which about you can say 20 odd billion-dollars is long-term forward book. So we don't have to worry about it right now. It's more than 12 months. So the effect on liquidity will only be seen after 12 months. And at that point of time, it will really depend on how the FX flows are turning around. As far as the 50 billion FX forward book is concerned, so even if you assume that RBI will let about 25 billion of its FX forward book mature, that you know uh, leads to a liquidity withdrawal of about 4.5 lakh crores. Right now, we are sitting at a surplus liquidity of 6 lakh crores. You add into the CRR cut of 1%, it adds about 2.5 lakh crores. So net, we are still in a very high surplus liquidity situation. So if you remember, in last policy, the RBI governor had mentioned that they will want system liquidity to be about 1% of NDT. So even if you, which is about 2.5 lakh crores. But if you look at all CRR cuts benefit the current liquidity plus the FX forward, we will still be comfortably between 0.5 to 1% of NDTL going forward also. So system will be reasonably in surplus situation for the next 6 to 12 months.
Great. Thanks. The next question is, we saw bond markets appearing to be somewhat disappointed on the policy day with 10-year benchmarks mildly inching higher. What could be the reason for this and how do you see the way forward?
So I think one of the reasons for the bond market performance was the change in stance. So, given that RBI changed the stance from accommodative to neutral, so bond market saw it as an end of easing cycle. So that was one reason. The second was the announcement of the CRR cut. Since now RBI has already preemptively announced the CRR cut, it also means that probably they will have to do less open market operation buyback going ahead. So one of the reasons for bond market very strong performance in last 6 months has been more than 5 lakh crores of OMO done by the RBI to infuse liquidity. So if now RBI is infusing liquidity through CRR, and so broadly that means one less buyer in the market. So there was some amount of profit booking that we saw in government bonds.
Thanks, Anurag. We have answered all the questions. We can conclude the discussion here. Thank you. So, thank you everyone for joining us today. We trust that the insights shared by Anurag have helped providing a clearer understanding of the current fixed income landscape and the opportunities ahead. We truly appreciate your time and participation today and look forward to welcome you in our next event. Thank you.
Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.